Good afternoon. Can you hear me? All right, great. How's everybody doing? Great. I'm Edward Bonner from SPRA, and today I have the pleasure to introduce Shane Williams of West Red Lake. He's going to talk to you about the Madsen mine. Most of you probably know about it from the several bankruptcies it went through, but this time they're going to do it right. So Shane, before joining West Red Lake, was the CEO of Skeena. He then was the VPO of El Dorado Gold. He also led projects for Rio and Conus Iron. And you might think his accent is a little funny, but that's just the Irish roots, so just don't, disregard that. So just a couple things about the project before I let him take the stage. They, after a successful bulk sample analysis, that kind of led them to restart the mine, and they're now ramping up the mine to an average annual production of 60 to 70,000 ounces per annum at 8 grams per ton. So this is high grade, small but high grade, and I think with a lot of potential to grow from there. The all-in sustaining is around 1680. The net NPV after tax is $500 million, and that's at $2,000 per ounce. So lots of upside there. So without further ado, I'd like to welcome up Shane Williams to the stage.
Can everybody hear me okay? Can everybody hear me? Good. So like I said, I'll apologize for the accent in advance, so it's hard to understand. So thank you all for coming. I think I'm competing with Rudy Frank and Keith Neumeyer, so that's been really good. You all managed to come. Thank you for coming. Also the Rick Rule Conference, it's been a great conference, so it's really good to be here. And this is my second year here, so it's been really good to be here. So a little bit I'm going to talk about some forward-looking statements. So there's our cautionary statement for forward-looking statements. Some key points of West Red Lake. So we are a gold producer. I came here last year, we were a developer. Today we're actually a gold producer. We're ramping up. We just started producing in March of this year, and we're ramping up production towards the back end of this year. So this is really our first year of getting into ramp up and production. It's been a good run. Basically, we were here two years ago. The company was just in vision, basically. We bought a mine. We bought a bankrupt mine. We moved it forward. Last year, we were just getting into development. And then 2 years later, we're in production. So that's a very good, quick return into cash flow as we speak. I'm going to talk a little bit about our process, what went wrong a little bit with Pure Gold, the last review, what we've done to de-risk the project, and then really the base case we have and the potential going forward. So, Red Lake, just to give people an overview of Red Lake. So, I'm not sure how many people know Red Lake, but there's a number of key mining areas in Canada. One of them is called the Abitibi, which is around Quebec and Ontario. One of them is Timmins area, which is again in Ontario. And the other area is Red Lake. Red Lake has produced 16 million ounces of gold at an average grade of 16 grams. So look, it's an area you want to be in. You want to grow a mine. You want to grow a company. That's the area to be in. Red Lake is the area to be in. There's a couple of mines in here. I'll point them out. This is the Red Lake mine, the original Red Lake mine, which was owned by Goldcorp. This mine has been producing since 1900. It has produced 9 million ounces of gold to date, and it still has a further 12 million ounces of resources. So lots of gold, lots of high-grade gold in the Red Lake region. And we have 2 projects in this region. One of them is our Madsen project here, and the other one is our Rowan property. So we have a great base to build a company from. I'd also point out in this area, another great project that was over the last number of years is the Great Bear project. Many people might remember that. It was a high flyer. It was bought by Kinross 2 years ago for $1.7 billion. So this is an area of high-grade gold where majors want to be, to get into. A little bit of the history of the project. Over the years, this mine has operated, as Don said, a number of different times. But I would point out that from the 30s to the 70s, this mine was very, very successful. It produced 2 million ounces at 9 grams. Then it was worked by a company called Pure Gold. They spent $350 million on this project. And in 2022, this project failed. It went into bankruptcy. Frank and a couple of other people are here. They saw the opportunity for gold over the next number of years. If I go back to 2022, gold was around $1,800 a gold. We saw the opportunity. We purchased the project for $6.5 million of cash and a 1% NSR, so about $42 million in consideration. So when you think about the money that's been spent on the project, and we also picked up about $170 million worth of tax losses. So when you look at the value proposition of the project and what we bought, a great opportunity, particularly in today's gold environment. Just to point out, people talk about gold, the price of gold. Some of the old timers that worked at this mine, their biggest thing was gold went from $350 to $400 an ounce. So when we talk about today's gold, they were mining at $400 an ounce. So that's important as you look at today's gold market and how we're transforming the mine. A little bit on what went wrong. So these gold systems are complex and they're highly variable. So you need a lot of work and a lot of effort into them. So I'm just going to point out a couple of things. The blue line, if you see the blue line there, that was the original understanding of the ore body. This blue, very linear, very straight line. This was the understanding that the Pure Gold group had going into the mine. They hadn't done the drilling, they hadn't done the work, they hadn't done the development. They had an understanding of the blue line. Effectively, what you have is actually the pink line. From our understanding and our drilling, this is the pink line. So when you go and you try to build a mine on the blue line and it turns into the pink line, this is what has affected them. They had lots of dilution, they didn't be able to get the tonnage, they weren't able to mine the mine. Now we've done the definition drilling as we've defined the ore body, and we've ended up with these orange-red areas. This is actually what the ore body looks like. After all the drilling, after all the work that we've done, after understanding of the ore body, we end up with these red shapes here. So you can see one of the reasons why they failed is they didn't have an understanding of the ore body, they didn't understand the ore body, and they weren't able to build a mine plan around it that developed. Also, they were drilling at 20-meter centers. We're drilling at 7-meter centers, just to take that down to context. We've done a lot of drilling. We've drilled over 100,000 meters post-Pure Gold in the last 2 years into this project. So that's really been the technical de-risking that we've done in the last 12 months as we developed the project. That really culminated in our last work that we've done, which was the bulk sample. So we took, after that understanding to show everybody that we did understand the ore body and we had got the ore body right, we took a number of stopes in the mine. We compared that to our model that we developed, what we predicted, how we predicted the reconciliation, and then we actually mined these areas. We put them through the mill. We got a good understanding of it. And our reconciliation was within 5%. So that showed that the model, the platform that we had was very successful. A very, very strong reconciliation. So that's the de-risking. We got good recovery in the mill. We got 95% recovery in the mill. And basically, we also did some test mining, how we would mine this ore body, what's the best way to mine this ore body, how we would move forward. So with that in mind, we made the decision to go back into production. And that was to restart the mine. And that was in March of this year, ramping up from there. We also put in a lot of capital projects on the project. We built a connection drift between the two areas of the mine so we could connect efficiency in the mine. We put in a new camp. The original operators didn't have any camp on the site. They were finding it hard to get people and ramp up. We put a tailing... One second, I'll just take some water. We put a tailings dam on the project. We dewatered the project. We purchased a lot of equipment. We put in a new dry and facilities. So we basically put a lot of capital as well into the project. So we drilled the project. We did the bulk sample. We put new capital in. All these are essential for making sure you have operational success as you build a mine. One of the challenges of the previous operator is they weren't really mine builders. They were exploration, they were geologists, but they didn't set the mine up for success as you go and do a mine. None of these facilities were in place. So we started the ramp up. We've produced, well, we're now over 6,000 ounces of gold. We've produced today over 6,000 ounces of gold on the project. We're pouring every 2 weeks consistently. We've done our bulk sample. We have more mining equipment to come. We're still getting ramped up. We have lots of trucks to come, new mining equipment to come all the time as we ramp up towards the back end of this year. You can see there our gold has consistently ramped up from March to April to May to June. And July, we're over 2,500 ounces a month we're pushing. The idea will be to be able to get, by the end of the year, to over 4,000 to 5,000 ounces a month consistently. That's as we're ramping up that area. And you can see the grade increasing. We did the bulk sample, and we started with the grade, and the grade is ramping up. Today I looked at the results of the mill. Now today, and for the last 4 days, we're putting 8 gram material through the mill. So it is ramping up, it is coming, it is as planned. A little bit on the story. As I said, I came here 2 years ago, or 2 years ago was here. We were just starting the project, buying the project. Last year we were a development story, we were here, and this year we're a producer. So there's not many companies who came here last year was a developer, and this year is actually a producer, as we've moved up that curve very quickly. Again, we put a pre-feasibility in case, and this is really our base case. Given the history of the mine, given the challenges of the mine, we wanted to be very conservative in our base case. So what we put together was a base project, about 60 to 70,000 ounces a year of production, an 8-year mine life, 800 tons a day, at an 8 grams. So it's a high-grade ore body. That was our base case. So I'll go into a little bit of details why we're moving from that base case, but that was done at $2,000 gold. So you can see sort of when you add the new numbers into that, sort of the upside from there. Again, I talked about our base case, but what I'm going to go through is we have our base case. What is the add-on additions on top of that? What is the value added that we're adding from all that work we've done? Also point out that because we did it with some consultants, they were very conservative in the pre-feasibility. Our mine design was based at $1,680 gold. So when they did the mine design, they did it at $1,680. So what that means is they focused on a very selective mine plan. They were very selective on our process and how we would mine it. Lots of development, lots of stopes, more of a sort of a remnant mine, small areas to mine, small areas. So that's how it ended up in our pre-feasibility, but still a good number to work from. Now as we've gone into the mine and done our drilling, done our work, we've ended up using, our mine design is using $2,500 gold, which obviously creates a lot of issues around bringing in more material. Remember, gold was mined at $300 an ounce before, so that opens up new areas, new gold. The cutoff lowers down, so 2 grams is a good cutoff now we're using within the mine. So anything above 2 grams is coming into that mine plan. And the importance for that, I'll show you here a little bit. This is really, when we bought the mine, everybody told us that it was a small remnant mine. It had a lot of development, small stopes, couldn't get the quantity. What we're finding from the drilling, and this is very important, is this was what it was before we were drilling. See, a number of small stopes within an area, lots of development. Post our drilling, you can see that that area has grown. As we're getting into these areas, as we're drilling them, as we're doing the work, the areas of mining are getting bigger. And we're moving away from this small mine with lots of little individual stopes to complexes, I call it, mining by complexes. And so you can see there by this drilling, this area called the 447 area has increased by 212% of stoping of tonnage and 320% increase in ounce in that one area. And the other area is the Austin area. Again, 200% increase in tonnage and 200% increase in ounces. So we're constantly finding that as we're going into new areas, doing the work, doing the drilling, it's getting bigger, each area is getting bigger and bigger. And why that's important is from a mining perspective, it gives you, instead of small areas, it gives you complexes to mine upon. So there's like 4 or 5 different areas within the mine to mine. So you can be efficient, you can put equipment, you can put people in those areas, and we have an 800-ton mill. So instead of trying to feed a mill with 800 tons, we're basically trying to fill a mill with 4 200 tons effectively from each different area. So that allows you to build scale, efficiency, and manage the complexity of an underground mine. So that's really what's happening. Every area we're going in, we're increasing the ounces, we're increasing the tonnage as we go down into the mine. So that's how we're building the scale. And none of this was in our pre-feasibility. We're finding this as we're going into the project, doing the drilling, doing the work. It's growing. So every area we've gone into, this is what's happened. We've drilled it out. It's growing in tonnage and it's growing in area. And now we have 6 different mining complexes in the mine, ongoing, feeding the mill at 800 tons a day. So that gives us a good base to build upon. Again, and that's important from a cost perspective as well. You know, different types of mining, cut and fill people might be familiar with, or long hole open stoping. Obviously, the most efficient way is long hole open stoping. The mine design was pretty much done on cut and fill. Again, small, inefficient, high cost mining of cut and fill. What we're finding, as we're finding these areas are growing and getting bigger, is we're moving to long hole. So all of 2025 plan is all long hole. So the cost of doing long hole versus cut and fill is much, much cheaper. That means more profit, more tonnage as we're building on top of our base case, again, as we're doing that. Again, this will give you one of the areas of the mine. This is our 1155 complex, the majority of this area. So when people say to me it's only about remnant mining, this area is 40% of our planned area across 5 stopes. All we have to do for 40% of our planned tonnage and ounces this year is 5 stopes. So, you know, it's one area, it's one complex, it's very efficient, it's stope after stope after stope. So this is to give you an example of, instead of 5 or 6, 7 stopes all over the mine, this is in one area of the mine, in 2 levels and 3 levels, 3 big stopes. And you can see as we're planning the rest of this year, the stopes are moving through those areas. And it's just 5 stopes. And so that's 40% of our ounces. One more area, another 5 stopes, another area, 5 stopes. So we're only really 3 areas. So 15 stopes to move this year, we'll move it out. So that's what we're finding, and that's the advantage of that area. Why does that happen? This is really some of the real high-grade nature of this ore body. You can see some of the fantastic grades here. You know, this has been drilled all of this year as we've drilled across the ore body. Lots of high grade in all different areas of the mine we drill. Everywhere we drill, we're getting those high grade ounces. And more importantly than high grade, you know, these numbers are fantastic high grade, but we're getting the mining widths. I'll give you an example. 16 meters at 8 grams, 12 meters at 61 grams, 10 meters at 114 grams. This creates not only high grade, but it creates the width, it creates the scale, it creates those big mining complexes. So everybody can talk about high grade, but you need the width as well, and you need the scale and the size to create a mining complex. Again, this year in the South Austin area I just pointed out, again, some spectacular 10 grams at 114 grams per ton, 10 meters at 12 grams, again, 8 meters at 43 grams, and then one hole, 0.7 meters at 1,600 grams. So, you know, very spectacular grades, but again, from a mining perspective, continuation of mining, managing mining, efficient operation, it's really the widths that are important. The grade obviously is important, but having those widths, having that scale, building that mining, building the tonnage, so you can feed your mill and keep your mill consistently going. Like I said, we have an 800 ton a day mill. That mill can be expanded to 1,500 tons a day. So over as we're getting into this ore body, as we're growing, we can get more tons, more areas, more complexes, and grow the project. Come back to this consideration. Our base case pre-feasibility, there's really a stepping stone really to more value on this project that we've kind of got to. So again, I talked about our base case pre-feasibility study, $500 million NPV, Canadian dollars. I've talked about our mining complexes, more mining, more tons, more scale, high grade, which brings efficiency in the mining. through that work. Then on top of that, we've got a number of near-term deposits that can feed into that project. Because we have the mill, the tailings facility, we have all permits in place. We can expand that I call it that hub and spoke model. We can expand that hub over the next number of years and bring more material into that. As an example, our Rowan deposit, I'll go through this a little bit. We just published a PEA on Rowan yesterday out on the project. 35,000 ounces a year brought that material into the Madsen project. So that gives you the scale of Madsen can grow with that Rowan deposit. Our Fork deposit is another deposit very close to us. Again, more production, more area, another area to mine, more flexibility. So that's the concept we're trying to build, that flexibility into underground mining. Again, I'll talk a little bit about them. This is our Fork deposit. Again, high-grade gold within the Fork deposit, and more importantly, it's only within 250 meters of the existing mine. It's right beside the existing mine. It's very easy to access, no permits, underground access. 250 meters is like 10 days of underground development. We're into that ore body. Again, another area of the mine that can come in, another complex, if I say, that allows us to bounce around a couple of these different areas, get that flexibility in the mining. Lots of areas in the mine, potential. I haven't even talked about our 8 zone. 8 zone is there's about 100,000 ounces at 15 grams in the 8 zone. 8 zone is, to us, it's the high-grade equivalent of Red Lake. Red Lake was very known for its high-grade zone. It was actually shaped like that, at the same depth, at the same type of rock in that area. The high-grade zone ran around 15 to 20 grams sort of material. So as we get down, we're dewatering the shaft at the moment. As we get down, next year we're planning to do this east drive here, and we're planning to drill that ore body. So this is another area that we can get into, very, very high grade. I like to give the analogy, just so people understand it. There's a project called Island Gold that Alamos Gold run, and John McCluskey bought probably 8 years ago. Very similar to Madsen. People hated the asset. He got a lot of focus on why you bought this asset, why you did. 8 years later, that mine is producing 300,000 ounces a year at 15 grams. It was an old mine like Madsen. It had failed a couple of times. It had gone through the process. It had gone through the CCAA. John bought that asset, saw the potential at depth, saw the potential to drill it out. Very similar ore body, etc. And now that mine is producing 300,000 ounces a year at 15 grams. Another analogy to this would be Fosterville in Australia. I don't know if people know Fosterville in Australia. It was bought by Kirkland Lake. 3 companies went through Fosterville. Crocodile Gold, another company, they failed. They went in, they drilled out the work, they did the work. Kirkland Lake bought the project, they drilled it out, they found the Swan Zone. The Swan Zone generated at 20 grams. That project came from 100,000 ounces a year to 400,000 ounces a year with one discovery, one zone, deep down in the system. And then those zones were at the same depth as our 8 zone, same type of rock, same orientation. So this gives you the potential of this project as we do the work and follow it through. Again, our Rowan property, we talked a little bit, our Rowan property, we put out, actually yesterday we put out our PEA, 35,000 ounces. Again, high grade, 12 gram material contained within 80 kilometers of our Madsen mill, our facilities. That material has been trucked across to the Madsen mill. Then again, easy for permitting, underground mine, no facilities, no mill, no big area. Again, use the facility, small underground mine, take that material, truck it across to Madsen and grow Madsen because we have that base. So when you talk about that picture, I talk about Madsen itself, I talk about Rowan, I talk about Fork, I talk about more discoveries, more complexes. It gives a lot of flexibility to grow. Our mill is 800 tons a day. The mill can go to 1,500 tons a day. It ran at 1,200 tons a day with pure gold, so it was already running at that. And with some small capital additions, can run to 1,500 tons a day. So we see a pathway on the Red Lake complex around Madsen to 150,000 ounces a year over the next 4 to 5 years. Between all these projects, expanding the mill, we have the facilities, there's a clear pathway with all this to 150,000 ounces a year, just in the Madsen area as a production center. That's our focus over the next number of years. Again, lots of exploration. We have 20 kilometers of strike along that key structural corridor where our Madsen is. We've had lots of intercepts in these areas. Again, lots of future potential along that target to do. Another one we had a discovery last year was the 8 zone, upper 8 zone. Again, this is our lower 8 zone. This is the 8 zone I was talking about. We believe there's a number of these stacked lenses along this ore body as we get up. We hit one of them this year called the upper 8 zone, very close to surface, very close to existing mine. It's got some great hits, 14 grams over 4 meters, 20 grams over 1.5. You know, this is sort of the potential you can find in Red Lake. That's why you go to these regions. This is, they call it, this is elephant country, where you can find these high-grade areas within the existing mine. And again, this is in addition to what I spoke about. These are new areas that we found, just early stage exploration. Very close to the existing mine. That material can be mined. It's close to surface. We can mine that, bring that material in very close. So a lot of potential to grow. And you can see how close it is there, this 8 zone target, very close to the existing mine, very close to the existing structure. Go back to this stage. We have a base case out there. This is our base case. But again, the potential is to step that mine as we have now, 800 tons a day, all the way up to 1,500 tons a day, which is, when you took it 1,500 tons a day, 150,000 ounce a year producer in Red Lake. That's our focus. That's our value of the company. That's what we're doing. It's taken us a bit of time to get there. We are stepping through that. We are doing that. And that's not a pie in the sky. That's not just saying that we want to get there. We have the Madsen, we have Rowan, we have Fork, we have bigger mining complexes. We're finding areas. There's a clear pathway for us all the way through for that potential. Again, our management team, I want to talk a little bit about our management team. And a lot of the people here in the mine who've built mines, built companies over the last 15 years, you know, the gold market is hit now. The gold mining, the gold bull will be over the next number of years, and you need a team to do that for the next 5 to 7 years. We've put in a very young team, lots of experience in the team. I've recently brought on Haley, who worked with West Dome Gold Mining, and I've brought on another person from West Dome called Sean McCormack. They turned around West Dome. Duncan Middlemas, who's on our board, he was the CEO of West Dome, so we brought the full West Dome team. West Dome started off 6 years ago doing 30,000 ounces a year. They're now doing 180,000 ounces a year. They took 2 old mines. One was called Kiena, one was called Eagle River in the Abitibi. They put in the right people, they turned those mines around, and today they're producing around 150,000 ounces a year. Just to give you context, their market cap today is $2.4 billion Canadian. And they started 5 years ago where we were. And we have a pathway to get to that value. Again, a little bit of our share structure, good shares. Frank is on the shareholder register. Sprott, we have some good share, 343 issues and outstanding, lots of warrants outstanding. Again, go back, I get a lot of questions on our capital structure. When I go back 2 years ago, nobody wanted to hear about the Madsen mine. Because of the history and the failures of the project, we had a lot of challenges to get the money. We got in place, but now 2 years later, we're in production. Another part of us is we've huge liquidity. We have a very, very liquid stock. Just to give you an example, there's all our peers where we are. You can see our liquidity has really ramped up. We're up to $3-4 million shares a day. So we have a lot of liquidity. We're getting a lot of value. A lot of big companies can come in. A lot of funds begin to come in because they can get liquidity. A lot of the companies here don't have a lot of liquidity, and it makes it difficult to get in, buy, and sell. We have a lot of liquidity in our company over the years. And that's because we're getting people to get involved in the story, understand the story. And that's West Red Lake. I'm open for any questions. I wanted to be more informal and have a bit of a discussion. Go ahead. Thank you.
Any questions?
Ed down there. Ed has questions. Yep.
How much cash do you have currently? What is the size of your exploration and brownfields program? and how much cash do you think you'll end the year with?
So basically at the moment we have $30 million on our balance sheet at the moment, $30 million Canadian I'm talking about now. But more importantly, as we're producing, we're ramping up production. So we're producing in July, we're going to do 2,500 ounces of gold. So that's about, in Canadian dollars, $8 to $9 million. So as we ramp that up, we're using less and less than that. So we don't, in our view, as we have now, we don't need more financing at this stage. The plan would be at the end of the year, as we ramp up, we will do 2,500 ounces in July, 3,000 in August, up to 4,000 by the end of the year. And our burn rate is roughly $10 million a month, $10 to $12 million a month. So we're nearly cash flow. I hope to be cash flow positive by October, basically October this year, cash flow positive, and then to start to generate as we go into next year and really ramp up the mill, ramp up the grades, we will be generating free cash flow by early next year.
Hi there. Thanks for the presentation and for the lunch. Can you go back to slide 21, please? Okay. So leading with the fact that my knowledge of geology is very limited, when you talk about, I think it was 21, some of these other deposits that you've identified, one I think you said was 250 meters.
That one?
Let's see.
That's it. Probably the fork deposit there.
Some of them, I'll have to go back and find it. Let me come up with a bigger, broader question. Given my limited understanding of geology and mining, it feels like there's a lot of little pockets, and you need to move your excavation equipment around. I don't know if it's once a week, once a month, to find these little pockets and reach them, and then go to the next high grade deposit. That seems inefficient. It is what it is, and I know these are very high grades. How does that affect your overall productivity?
I go back to this one. Yeah, the original concept was that when we bought the project, but as we're doing the drilling and as we're doing the areas, these complexes are forming, and these complexes are forming a little bit that they're becoming bigger in area. That's one mining complex. That's going to be mined for the next year and a half. So it's not about moving, it's about putting people in that area, putting equipment in that area. That area will be mined for the next 2 years. So that area, that's a big stope. So there's probably 40 to 50,000 tons of material in there. So that would be mined for the next 2 years. So it's not about moving. Originally, the concept was more like this, where people thought of it as a small area, and we would move around, and it's inefficient in scale. But from the drilling and the work we're doing, they're becoming much bigger. They're becoming the complexes. They're forming much bigger. And when I mean complexes, I mean areas where you can put a team for the next 2 years. So you get efficiency. You bring the trucks, you bring equipment, you bring people, and they're focused on these areas where you get the efficiency. So as an example, this 1155 complex, there's 52,000 tons in that area over 5 stopes. These are average stopes. These are 10,000 ton stopes each. These are big stopes. They were small. The original concept of Matson was 2,000 ton stopes to give you the scale. 22,000 ton stopes spread everywhere. So yes, that's inefficient. You need to move. But when you've blocks of area of this from the drilling, with the grades we're getting, there'll be a team of people working here for the next 2 years, because you'll take it out over time. And this is just one part of it. As you go down deeper, there's another area here. So it is, the areas are developing much bigger, much bigger.
Questions?
I'm a shareholder, and I love your story. Question, if you have a possible answer for it, is the stock has been under pressure for like the last 30 days. You have any explanation as to why that might be?
Well, obviously, gold is at the moment is a consolidation phase, is one part of it. I think as well, what we have done is we've announced production, but we haven't been clear and guided the market to where we are. I'll go back to that a little bit. We've tried to be tried to be a little bit conservative, I would say that, given the history of the asset, and we don't want to go and say, hey, this is what we're doing, and be all up there. We have been a little bit conservative. Like I said, we've produced 6,000 ounces today. We have to start, and we are going to start. We were working on the Rowan PEA. We will start now giving monthly updates of where we are, what we're getting, the grades we're getting, and I expect when people see that, they'll see us make that progress, and that will help the market understand that we are in production. A lot of people still don't actually know we're in production. They ask me that. We haven't been good at communicating that, and people will see that over the next 3 to 4 months.
On your presentation, you had annual free cash flow as 93 million Canadian dollars, but you had just said something to a previous question about hoping to be cash flow positive or something. Can you elaborate on that?
Yeah, so when you're starting a gold mine, you're spending a lot of cash. You're spending your capital, and basically as you start to ramp up, you're selling gold. And so there's a break-even point where we have 200 people on site. I have 250 people on site. I have equipment, fuel, labor, costs. So that's a run rate of about $10 million a month we're spending. So basically you have a balance of you produce gold and eventually you pass that area as you ramp up. So the cash flow positive is we're producing more gold that's covering our costs effectively.
So that 93 million, that's gross, not net.
That's on a full year, a full run rate over the full year.
Okay. Thank you.
Questions?
Very good presentation, Shane. Quick question. As you ramp up production, is the equipment there newer or older? So once you start to stress run a lot more product, older equipment tends to break down versus newer equipment. So where are we at? Is our equipment newer, older, rebuilt?
Yeah, unfortunately, when we took over the mine, basically because of the bankruptcy and because of and I don't really like to talk a lot about the previous operators, but when they failed, basically everything went into bankruptcy, and everybody who had equipment dragged their equipment off the site. So when we turned up, I call it the graveyard. We had a graveyard of equipment that was left over. So we started with very poor equipment, 15 years old. We didn't have good equipment. They were old. And over the last 18 months, we've been buying new equipment. So we've started that process. We're not there yet. We've brought on, and I'll talk a bit Thursday. We've brought on about 19 new pieces of equipment. So we've brought on nearly a full fleet of new equipment over the last 18 months. So we're turning that around. Obviously, maintenance costs, et cetera, are getting better. And we've bought, and as I speak, we still have more equipment arriving. So as we do that ramp up, we have more equipment arriving. We've 2 more big haul trucks to come. We've more scoops. We've more order. That's changing all the time. So probably by the end of the year, into next year, we'll have our full fleet of new equipment. We'll have processed that. But it takes some time, lead times, orders, et cetera. So that's really transitioning the fleet through from the old to the new. By end of this year. Like I said, that's the last piece of equipment to arrive that was ordered last year. There's a lead time on these equipment. It takes a while to get here. They're the last piece of equipment to arrive this year for full production. And that's why there's a ramp up for the rest of this year. We need to get these 2 haul trucks, as an example, to move more material to get to that 800 tons a day consistently.
One more question.
So Shane, thank you for the presentation and for the wonderful lunch. My question is your ultimate goal to become a 150,000 ounce producer, or is your vision, your goal, something higher, and how would you like to achieve this?
Yeah, so like I talked about, Madsen is the base. There's a vision, there's a clear pathway in Madsen, in Red Lake, to 150,000 ounces. That's a clear pathway. We have the resources, we have the men, we have the facility. Our focus, and I'll take a little bit from Frank here, is the buy and build strategy. You know, we got an asset, we got a base, we spent work to de-risk that base, but that gives us a good base to look at the next project, looks at the next opportunity. So the idea was always to use this as a base for the company to grow. My objective would be to get to 500,000 ounces of production over the next 5 years. That's the objective I have. That's what Frank's view is as well, and this is what we're planning to do. But first we had to get Madsen. We had to show we could make Madsen work, make it grow, and then use that as a base to grow. So the idea would be to have a number of these regional areas. Red Lake would be one, with a clear pathway forward. Then another area, get into an area, and then have a path forward to that. So we had a number of these hubs running. Then at that 150,000 ounce, that's how you scale up. A number of years ago, there was a company, the Canadians will understand, called Glamis Gold. Maybe people remember Glamis Gold. They built a large mining company with a number of these smaller 60 to 100,000 ounce producers. And they built scale that way, and then they were bought by Goldcorp. So that's, I think, a good model to do. The other opportunity we have, as I go back to our team, there's a lot of big companies, and they're buying more big companies. And there's a lot of junior companies with developers. There's very few companies that have the team who can take assets and turn them into production, from development to production. There's very few teams that can do that anymore. There was a few, and we see ourselves as one of those teams. So that gives us the opportunity to buy tier 3 assets from the majors, to buy failed assets and turn them around. So I think that's a sweet spot that we have that others don't have, a competitive advantage.
Oh, thank you. We have to wrap up now because it is 1:45, but Shane has 30 minutes to stay here for questions. So if you'd like to do that, you can speak with him. And thank you for coming today, and we hope you become West Red Lake shareholders if you are not already. Thank you.